Good morning.
Good morning, sir.
Okay, so today we agreed to get through some few more questions on that area. And here there's a question in page 2, a company called Eco Company. Page 2, a company called Eco Company. So go through it. We do part B and part C. Part B and part C. D, I think you can do it on your own. So D is asking us, discuss. Let me meet some people here. So part D is asking to discuss the advantages of leasing and self-finance. Okay, we did that yesterday. Okay, of balance sheet financing, maintenance cost. Okay, so let me not repeat that. So let's do B and C. For now, we can't do A because we're not done it. So let's do B and C. So go through the question. We attempt to do it together. Eco Company, page 2, page 3, page 4. Yeah. Okay, I think let me use Excel to do this presentation. Okay, so here you've been told that you have two options, option A or option B, and option C actually. So you had mentioned for now you can't do option A. So let's do option B and option C. In option B, the company would want to raise 15 million of new debt. Okay, although there is no current investment, the cash should be invested in a short-term basis until a suitable investment arose. Okay. The notes would be, you'd pay an interest rate of 10% per year and will be redeemable in 8 years' time at par value. Okay, so the company want to issue money. Okay, would want to issue a debt. Okay, in the market. I'm not sure why they want to do that at option B, because it makes no sense at all to do that because you don't have any investment making, but you aren't going to issue the money. Anyway, let's do it together. So first of all, there's some data given there. Okay, we'll call the interest coverage ratio. We have long-term debt to equity. Okay, those are the measures of the company exposure towards financial risk. Okay, so generally, when it comes to the gearing of the company, okay, we use the debt to equity ratio, and you can use either the debt to equity ratio using book value or use the market value basis. Okay, so in this example, the debt to equity ratio is given in book value basis. So we use as it is. Okay. So the other company have an average of 80%. Currently, this company has a gearing of how much? We need to do that. The company has equity of 20, a note of 30. Therefore, the company gearing, this is Eco Company. Okay, so the company current gearing, okay, is equal to the debt, the equity of this company, debt to equity, the debt to equity ratio. The debt of this company is 30 million, so 30 out of equity, and the equity of this company is 20. Therefore, 20. Okay, we express a percent. Therefore, currently, the company gearing ratio is equal to 3%. So definitely, if you have to compare this gearing with the other company, with the industry, this company has an excessive gearing because the other company have a gearing of 80%. Okay, 80%. Okay, the company gearing here, okay, is 150%. This is the company has an excessive gearing, too much gearing. Okay, if you have to compare with the average firm. of 80%. Now, the company issuing debt, I think, is going to make things worse off. Okay, because they're going to issue a new debt at 15 million, and they have no investors who want to make the money in. Okay, therefore, if the company goes ahead with the proposal, okay, the gearing under the proposal, okay, what's happening there for the company? Debt has increased. Currently, it's 30 plus the new 15. Okay, they're issuing a new 15 million worth of debt. Okay, the equity, there's no change in equity. Okay, I don't think there's any change in equity of the company because this company is not going to invest its money anywhere. Okay, they have the company gearing. Okay, the company equity remain as it is at 20. Okay, 20. And so therefore, the percent to give therefore 225%. So is this a good proposal? No, it's not. It's a very bad proposal. Okay, you can make a comment. Okay. The proposal. Yes.
Could you please repeat this part?
Which part?
Under the proposal.
The proposal.
Under
okay.
the
Under the proposal, the company current. What's the company current debt? What's the company current
20.
debt?
20. 20.
No. Sorry.
30. Sorry.
30. Okay. Then we are going to issue another 15 million worth of debt, isn't it?
Yes.
As per proposal B, isn't it?
Yes.
Therefore, the combined debt for this company is 30 plus 15. The company equity doesn't change. It remains at 20 where it was, isn't it?
Yes.
Yeah, that's what therefore that's what you get for 225% to become for the gearing if the company continues with the proposal. Clear, Sakina?
Yeah.
Okay, great. Therefore, if the company goes ahead with this proposal, then the company gearing, instead of improving, it becomes worse off. Okay, to improve becomes worse off. This is a good proposal? No, definitely not. Okay, therefore we can make a comment. Okay, the proposal C will result. Okay, will increase the company gearing. Will increase the company. Will increase the company gearing from 150%. 50%. Don't forget this is already bad. Okay, 150%. And already worse situation. And already worse of situation. Compared to the industry average. Compared to the industry average gearing. Gearing of 80%. Okay, they could increase the company gearing from 50% to 25%. Okay, this is not a good proposal. Definitely, it increases the company gearing. Okay, that's the first proposal. Okay, that hey, if the company goes ahead with this proposal, then the company gearing will increase to 225%. Okay, clear?
Sir?
Okay, yes.
In general, the gearing ratio should reduce, yeah?
Okay, because it's not a must to reduce, but you compare with the what is the industry average? The industry average is 225%. Is 80%, isn't it?
Yes.
So currently, your situation is your gearing is 150, and now you want to issue more debt. It doesn't make sense.
Okay.
No, it doesn't make sense. So what you be doing is reduce the gearing, but the company is doing the reverse. They're increasing the gearing. Okay, I think that's gonna be a comment. The company should be aiming. Aiming to reduce the gearing. Should be aiming to reduce the gearing. By this proposal, is, or will make things worse off. Will make things worse off. Okay. So because you ought to be reducing the gearing because it's already high. It's 150%. Okay. Therefore, you should be reducing the gearing, not increasing it. But that's what happening. That proposal be clear.
Yes, thank you.
Then the next is the use of what we call the interest coverage ratio. The interest coverage ratio that the company goes ahead with this proposal, then I guess the ratio will be increasing. The use of the interest coverage ratio, okay, it is used to indicate the extent of the company financial risk. Okay, now financial risk of a company is simply what is the possibility that a company you may be unable to pay for your dues, okay, to pay your interest, to pay your preferred dividend, to pay what we call the payment to the prioritized capital, but it's becoming worse off. Okay, what the chance? Financial risk. Let me just make a mention. Okay, financial risk for company is the chance, is the risk. That is the firm that the firm may be unable. The firm may be unable to pay for its obligations. Its obligation due to its finance structure, due to its financing structures. So what is the chance that you may be unable to pay for the obligation? Okay, simply because of the way you're financing your assets. Okay, that referred to as the financial risk. Okay, so in this extent, one of the issues used to measure the financial risk is called the interest coverage ratio. Okay, and how do you get that issue? Simply the ratio is given us. Okay, the interest is given us. Interest is given us. Although the interest is the number of times the company can be able to pay off the interest using the profits. Okay, it is a ratio. The ratio of how many times, or the number of times that the firm can pay off its interest, from its profit or from its earnings. Okay, that's called the interest coverage ratio. Okay, and the ratio is given us. Okay, the ratio is given us is equal to the profit before income tax is given as profit before income tax. We divide by the interest. Okay, divide the interest. Okay, so you can see that for currently the company has current position. The company has a ratio equal to how much? We need to work that out. Okay, and this. The company profit before interest and tax is 9 million, so is equal to 9 million. We divide by the interest. Where is the interest? It's 12 million, sorry, it's 12 million. 12 million, we divide by the interest, and the interest here is 3 million. Therefore, currently this company has a ratio 4 times. That means the company can be able to pay its interest 4 times from its earnings. Okay, therefore, definitely the higher the ratio, the better the company is in terms of is management of risk, is management of financial risk. Therefore, if you observe, okay, the other companies in the industry have a ratio how many times? The industry average is how much?
8 times.
It's 8 times. Now, what does it indicate? That you as a company you have a high financial risk. Why? Because there is your interest coverage ratio is 4. The market, the industry has 8 times. Then we are way off the industry. So already you have a high financial risk. Therefore, this proposal, unless it's going to improve that situation, that is increase your ratio, then it's going to be an improvement. And let's see. What if we do the proposal? So under the proposal, what should be the cover? The cover will be equal to this company. The company profit, there's no any improvement, so it remains as 12 million. The interest of the company is increasing because you're paying the interest. This loan, you're paying 10% per annum. Okay, so the proposal, we call the new interest, we just see the new interest, you'll be paying, will be equal to 10% of 15 million. Therefore, the new interest will be paying 15 million. Therefore, the revised total interest will be therefore equal to you're paying 1.5 million from the new debt you have issued plus the old debt, okay, plus the old interest you used to pay, which was equal to 3 million. Therefore, in total, this company therefore will pay 4.5 million worth of interest. The profit is not increasing. Therefore, the ratio therefore will be equal to, okay, 12 million. We divide by 4.5 million and we get 2.67. So instead of improving the situation in terms of financial risk management, it's increasing. Okay, it becomes worse off. The company financial risk therefore be increasing. Therefore, this is not a good proposal, definitely. Okay, this therefore is not a good proposal. The company, could you just make a comment? The company currently has a high financial risk, okay, as indicated by its low interest coverage ratio of 4 times when compared to the market. Compared to the market or to the industry, compared to the industry, and compared to the industry 8 times. And compared to the industry 8 times. And compared to the industry 8 times. The proposal B should thus aim to reduce the already high financial risk. Okay. However, it is making things. It results to a decrease in the interest cover ratio, a decrease in the ratio to 2.7 times. Worse of situation. Yes, so that's what you're meant to comment on proposal. Let me see this. As you're meant to make comment on that particular proposal. I'm not sure how I should. I wanted this to appear, and I'm not sure. Anyway. Yeah, here it goes. Okay. Therefore, it's making the situation worse off. Okay, it is making the situation to be worse off. Okay, it ought to be improving, but what is happening here is the company becoming worse off in terms of management of its financial risk. Clear?
Sir?
Yes.
Why did you multiply the new interest with 15 million?
The new interest 15 million. Because you want, don't forget this debt that you want to acquire. How much interest do you pay? The new debt you want to issue in proposal B.
10%.
10%, isn't it? How much are you issuing? Or how much are you borrowing?
Borrowing.
Yes, the proposal B, how much are you taking? How much loan are you taking in proposal B?
Oh, 15 million.
15 million. Therefore, how much in new interest, therefore, do you pay in proposal B?
Okay, 1.5.
1.5. Plus the old interest you used to pay, isn't it?
Yes, thank you.
Would you still continue paying? Okay, which therefore give therefore 4.5 million. Clear?
Yes, thank you.
Okay, okay, great. Any question? That's in proposal B. Okay. If there's no question, then you go to proposal C. In proposal C, okay, you're meant to get the theoretical. No, these are 7 marks. That therefore you need to have more discussion. You can't just do the calculation and stop there. Okay. You need to do therefore do this other discussion you just done here. Okay. Okay. So in proposal C, the company want to raise new capital. Okay. One for 4, okay, at a discount 20%, and the current market price is 2.3, and we expect this going to reduce the company gearing and the financial risk. Okay, we shall do that evaluation to see whether this is going to be the right thing. But first, let's get the theoretical share price. Okay. This is proposal C. So therefore, we get theoretical excited share price, which will be equal to is a 1 for 4. You're going to get 1 you share. How much do you pay? You're going to be paying 80%. Okay, there's a discount you're receiving. Okay, so you don't pay 2.3. You pay 80% of 2.3, isn't it? Okay, plus, don't forget, we need also to add the value of the old share. You're going to get 1 new share, but you must have 4 old share. The value of those 4 old share is 2.3. That does give the total value of the company, old share, total value of the shares of the company. The 1 new share plus the 4 old share which you had. Okay. We divide therefore by the revised share you have after. You have 1 new share plus the 4 old share you had, which is 5. Clear? Yeah, therefore a theoretical exercise share price of 2.21. Clear?
Sir, please repeat that again.
So first of all, how many new shares do you have? You're going to get 1 new share for every 4 old share you had, isn't it? Sanya? Yes, so you got lost. Sanya, Sanya, come back. But I can answer you.
Yeah, I'm here. Sorry, my internet.
Okay, okay.
Just show this formula. It's okay there. I understand.
Okay, fair enough. Okay.
Yeah.
Therefore, that's how they forget therefore the theoretical X, right? Share price. Okay. You're going to get 1 new share, which you'll be paying 80% of the current price, which is 2.3. Okay. And for you to get this 1 new share, you must have those 4 old share before. Okay. Therefore, 4 times 2.3, and we divide by the total number of share after. The 1 new share plus the 4 old share give us therefore a combined 5 shares. Okay. That's on proposal C. Okay, the first part you meant to get the theoretical. Then the amount of finance that will be raised under the proposal, the amount of capital you'll be raising. Okay, the amount of capital you'll be raising. Okay, will be equal to the capital will be raised, therefore will be equal to the number of shares you'll be getting. Will be equal to the price, the issue price. Okay, is 80%. Okay, of 2.3. That's the amount you get from every share you be issuing. Okay. Then how many shares do you issue? You're going to be issuing 1 for every 4. Okay, 1 for every 4. It's a 1 for every 4. That means therefore currently, how many shares does this company has? The total nominal value of the company share, if you go as per the balance sheet above there, is 5 million. 1 share has a nominal value of 50 cents. Therefore, the number of shares this company is equal to 5 divided by 0.5, which is 10 million. Therefore, times 10 million. Okay, times 10 million. Clear?
Sir, could you
Sorry?
Could you please repeat?
The amount of capital you'll be raising is how much do you receive per share? You receive 80% of 2.3. Clear there?
Yes.
Then how many new shares are you going to be issuing? You're going to you're going to be getting one new share for every 4 old shares, isn't it?
Yeah.
So currently, how many shares do you have? You have 10 million shares, okay, as per the balance sheet. You've seen that? As per the balance sheet, the company has share worth 5 million in terms of nominal value, and one share has a nominal value of 0.5. Then how many shares have been issued? 10 million shares. Clear?
Yes.
If we be issued, therefore, one for every 4. Therefore, you do a quarter of 10 million. Clear?
Yes.
Okay, great. Therefore, that was given for the amount to be received from the company, from the issue of the capital to be received from the issue shares, 4.6 million. Okay. Next, we need to do the evaluation where the proposal is going to reduce the gearing and financial risk. Therefore, we need to determine, therefore, we have done already the company current gearing. Okay, we have done that already, the company current gearing. So we're going to do the gearing and the proposal. So gearing, okay, and the proposal will be equal to the company debt. The company debt is not increasing. Don't forget, the company debt is not increasing because this is equity. This is right to your share. If the company debt is not increasing, therefore it remains as it was. Debt remains at 30. However, equity of the company, it was 20 before. Okay, it was 20 before. Then the company has issued share worth 4.6 million, isn't it? They come to here. These are shares worth 4.6 million. That's therefore clear. Therefore, the gearing of the company, the new gearing, 30 million, which was debt before, the debt of the company doesn't increase. However, the company equity is increasing in line with the number of shares that are being issued in the markets right now, worth 4.6 million. And that's therefore given for the company gearing. What does that mean? Oh, this is 4.6 million. Let me simply adjust here. Well, this is, for me, just 4 million. 4.6. Here, therefore, 122%. Is that clear?
So
okay,
why are you adding 4.6 million?
Sorry?
Why are you adding 4.6 million?
Which is the 4.6 million here is the capital that you just raised. These are shares you have issued in the market, isn't it?
Yes.
So are they, what are they? They are part of equity, isn't it?
Yes.
Therefore, that's why I'm adding here. Don't forget here, the denominator here is equity. Don't forget here, it's 20 million, which was equity before, plus the new shares you have issued, 4.6 million. Clear?
Okay. Thank you.
Okay, great. They'll give us therefore 122%. We go for the gearing in the company after the company has issued shares. So it is decreasing, but it's still too high. Don't forget, it has decreased from, I think it was 150. Yes, don't forget here it was 150. Before it was 150. Now this has decreased to 1.2%. It's an improvement, but not the very best improvement. Okay, but it's an improvement. Let's do the financial risk here. The use of the interest coverage ratio. The interest coverage ratio will be equal to this company, okay, doesn't actually change. The interest the company is paying remain the same. The profit this is not increasing because the company is not investing the money. Is it investing the money? Where is this one go, by the way? This is in order to reduce gearing financial risk. So there's nothing. So the company gearing then remain constant, isn't it? It remains constant. Let's see, because here, and let's assume, okay, these are assumptions we're going to make here. These are assumptions we're going to make here. Assumption we're going to make. The company, these funds the company has raised, okay, the company will reinvest its funds, okay, and the company, where the company is currently investing, this way the money will go. That's an assumption. Let's make that assumption. Okay, therefore we need to get what called return on equity. Return on equity, we determine currently the company current investment, how much they yield. Okay, how much do they yield? Okay, currently the company is making a profit of how much? No, return on equity is simply the net profit. Okay, then call the net profit we divide by equity. Okay, net profit divided by equity. Okay, therefore currently the company, if you go as per the company balance sheet, the company stated financial statement, the company profit for the period was 6 million. Okay, 6 million. We divide by the equity, which was 20 million. Okay, as a percent, we get a return on equity of 30%. Therefore, the company current investment yield 30%. So here we made an assumption the company will be reinvest the funds. Okay, will invest the funds at the current where they invest the money currently. Okay, which means therefore the amount of earnings to the company is making from these investments, okay, will be equal to the revised earnings of the company. Okay, let me call this revised earnings of the company. The revised earnings of the company, therefore, will be equal to the rate of return on equity, we multiply by the revised equity. The revised equity we got was 20 plus 4.6 million, which is therefore 24.6 million. That's clear. So we assumed that this funds, because there's no mention on where the company invests, so we made an assumption that this funds, the company, okay, we are going to be, the company is using these shares to invest in its current project, okay, where the current project are earning a return on equity of 30%, okay. Therefore, the earnings of the company after the issue will be equal to, therefore, 30%, okay, of the company equity. And the equity is 20 million, which was there before, plus the new million, plus the 4.6 million, which the company has together for a return of 24, return of, how much return is it? 7.38, an increase from 6 to 7.38. Clear? Okay. Now, since we have now the new earnings, the new profit, therefore, the interest cover ratio, therefore, will be equal to the new earnings, okay, 7.38. We divide by the interest, which doesn't increase, okay, it remain at, I think it was 3. Then the interest doesn't change, it remain at 3. Give us therefore 2.46. That's the interest cover ratio. Just a minute. It ought to be improving because here the company has made more earnings. It ought to improve. I think we need, let's do the better way. Yes.
I think we have to add 12 to it. 12 to
12 million is the current, yes. So we need to get, let's just the earnings from the project only. The earnings from, let's say, raised from the funds will be equal to the earnings from only the 4.6 million will be equal to 30%. Let's adjust that times the funds you have raised, which is 2.6 million. Then the earnings only from these funds is equal to 1380. Okay, equal to 1380. That's the only funds from this investment. However, these are net. So we work backward. Do you pay tax, by the way? In this case, do you pay tax? Do you pay tax? Yes, there's tax expense there, and I'm not sure the tax rate there. So I think when the tax rate, yes, we can work backward because the tax expense is 3 million. The profit before tax is 9 million. Therefore, the tax rate for this company is therefore 30%, isn't it? You guys, I'm asking a question. The company has a profit of 9 million, profit before tax of 9 million, and income tax expense of 3 million. There was the tax rate there, 30%, isn't it? 9 divided by 3, is that much? Is it 30%?
So you said 9 million divided by 3 million.
Yes, as per the company financial or the P&L, the profit and loss account they are given, the profit before tax is how much? Is 9 million, isn't it?
Let me check.
As per the statement, this they are given there. As the company P&L, isn't it?
Yes.
The income stream is how much? The income tax is how much?
3.
3 million. So in case you work backward, what therefore is the tax rate? This with simple 3 divided by 9. To give us how much?
33.3%.
Oh, that's 3.3. Oh, no, okay, the 3.3. Okay. Then we can assume that that's with the tax rate. Okay. Which means therefore, these are, don't forget this one, these are net profit. Okay, they are net profit. And the 12 million is profit before tax. Okay, before interest and tax. So you work backward, we get therefore what ought to be the earning here before tax from this investment. It will be equal to the 1.3, which is after tax. Okay, we divide therefore by 1 minus a third. 1 minus a third. We have that here the tax rate. They are 3.3%. So you're trying to work backward. I hope you're getting the concept here. The 1.38 million is return received from this project, from these funds you have invested, okay, to give us 1.38 million after tax. Okay, so this return on equity is after tax, don't forget, is net profit. Then work backwards, determine therefore what is the earning before tax from these funds only. Is equal therefore 1.38 million. We divide by 1.1 minus the tax rate. Therefore 2070. Is that clear?
So how did you get earnings from funds?
From the funds. The earning from the funds was simply equal to how much time do you get? 30%. How much did you invest? 4.6 million. The return you're making 30%. How much have you invested? 4.6 million. How much therefore do you earn? 1.38 million. Clear?
Yes.
Okay, therefore get therefore the earning before tax from this investment will go to 2070. Okay, don't forget the 1.38 million is equal to 66, and this is a third or 2/3, I think 2/3 percent, because this is after tax. Therefore, what about 100%? It's just what we just here. Okay. Well, this is the profit after tax. After tax. Okay. Then having done that, we have now the earning before tax from the investment. Therefore, we can say revised earnings, revised earning before tax, interest before earning tax from the investment is the 2070 plus the 12 million, which you already have, okay, from the old investments, 12 million. Here the 1470. Therefore, the ratio, therefore, will be equal to the interest cover ratio, therefore equal to the earnings of the company divided by the profit, before we divide by the interest, which remain at 3 million. Get 4.69. Is that clear?
Sir, could you please repeat from revised earning before interest and tax?
The reverse earnings, okay, before these funds were used by the company, what's the company earnings before tax, before interest and tax?
2.7.
Afisa, yeah, sure. What's the company current earning before interest and tax? Before this investment has been made, before these funds have been made, as for the P&L, it's given there.
$12 million.
12 million, yes, 12 million. Then how much do you earn from the funds you have just raised, the 4.6 million, the 2070, isn't it?
$4.6.
you get 2070, no, you get 46, 2070, the earnings you make from the investment. You have been given 4.6 million. You go and invest. Every year you earn 30%. How much do you earn? 2070, isn't it?
Yes.
Plus the old earnings you had, 12 million, isn't it?
Yes.
Therefore, the combined earnings you have, 2070 plus 12 million to give us 1470, isn't it?
Yeah.
Yes. And then you divide by, don't forget, you don't get the interest coverage ratio, which is the profit before interest tax divided by the interest. Okay. The interest of the company is still at 3 million. It doesn't change. It is as it was before, because this is equity financing, not debt financing. Clear?
Sorry, could you please repeat that?
This financing method is right issue of share. Is it debt or is it equity? Is equity. There is no any increase in the company interest payment, so it remains as it was before. So it remains at 3 million.
Okay.
Clear?
Yes.
That's therefore what to be our new ratio. Okay.
Sir,
Therefore,
could you show the formula, please?
sorry, the formula.
The formula. Yeah.
Okay, there you go.
Thank you.
Okay, now that's on that. So now we make a comment. Okay, is this proposal good or bad? Okay, we go back to the comparison we are making with the other firm. Okay, the other firm had a gearing ratio of 80. Now this is 1.2. It has improved, okay, because it was 150 all the way to 1.2 from 150 to 1.2. However, it's not yet there, okay, because if for us to say that is a good proposal, then the new, okay, the term to use, the gearing in the company need to be at least at around 80 or even lower. But this is not yet there, so it's not a good proposal. Anyway, to us the financial risk, okay, the other firm have a ratio of 8 times. This one, it has increased from 4 to 4.69. This is a good sign, but is it yet there? No, because the other firm has a ratio of 8 times. Yeah, this is not a good proposal, therefore. It's not making you achieve any of the objective you had set. Okay, so you can make a comment. The proposal C, seems not to be a good proposal, seems not to be a good proposal, not to be a good proposal, a good use of funds, a good proposal, a good use of funds. Since the gearing of the firm is way too high, gearing the firm 1.2%, 1.2% is way too high when compared with the industry. With the industry. With the industry. It has decreased the gearing. It has decreased the gearing. Did you make the comment? Don't forget, here there's more marks for the comment. It has decreased the gearing from 150 to 102%, but not yet good, but not but still not enough. That's one towards the gearing. Towards the without age. Let me move this text here. That's on that particular comment regarding the company gearing. What about the company financial risk? Okay, company financial risk. Financial risk is still too high, as shown by a lower index coverage ratio. Index coverage ratio of 4.6, 4.7. Okay, 4.7 times, which is a low financial risk of compared to the industry average. Is an improvement. But not enough. It is an improvement, but not enough. Therefore, in reality, then it doesn't make any sense for sure. Okay, therefore it does not make any sense for the company. Therefore, okay. So, in conclusion, the proposal C. In conclusion, proposal C. It's not a good proposal. It doesn't achieve it. It does not. It doesn't achieve either of its objective. It doesn't achieve any of its objective. Intended objective. This question, don't forget to be very careful, because most of the marks are towards the comment. Okay, most of the marks are towards you making the comments. Okay, and making the appropriate comments. Okay, clear? Okay, since it's clear.
Sir?
Mm.
I'm sorry, but is I don't know if it's only me where I cannot hear you.
Oh, you can't hear me?
Yeah, is it just me? Like it's getting cut.
Is that the case to all of you? Sakina?
No, it's fine.
Oh,
No, it's just me. Sorry.
okay, don't worry. So anyway, if it's something that you missed, then let me know. That's on that proposal, okay? That's on evaluation of that particular proposal, okay? Clear? Those are how many marks? Those are very many marks, by the way. Let me just, I think how many marks are those? Are they 12 or 14 marks? I don't know how many they are. Those are 14 marks. So don't be surprised that maybe, I don't know, in case maybe your examiner decide to bring such a question. But these are free marks for sure, okay? They are quite free marks for sure. Clear? Okay. Now, let's go back to the question. Now, we do one final question. Okay. We do one final question. And there's a question here which I think was a good question, where you're going to issue shares, okay, so that you pay off the debt. then I meant to make a comment whether the company proposal to issue shares to pay the debt, okay, is a good proposal. Let's see if I can get it. I think that was a good question. It's in our question bank here, so let me track it. If you see it, let me know. So the company is using shares to pay off a debt. Then you meant to do more or less like what you just done there. You evaluate whether the proposed use of funds is good or bad. I think this is question here. This is in page bar company in page 32. Bar company in page 32. Bar company in page 32. So go through it. We do part. Actually, you can do the part A, part B, part C. Yeah, okay, you can do part A, part B, part C. Bar company, page 32. So go through it. We discuss together. Read together. Okay. So this question being asked in part A, the theoretical exercise share price. Part B, we determine whether the company's use of funds, okay, is financially acceptable to the shareholders. Definitely, this is about the way of the shareholder, okay. And part C, the effect on the company financial risk, okay, as well as the company gearing, okay, like just what we done in the other example, okay. So let's do this question together. Bar company. Okay, look at this bar company. Let me just add it here. Let me expand these. Okay, there we go. So we know the heading to get the theoretical exercise share price. Theoretical exercise share price, very simple one. So first determine how is the offer going to be made. The offer being made here is the one. It's what the one for the stock market. Okay. The company want to raise 90 million. Okay. And they're going to do so. The price, the offer price, okay, yes, do it in bits. First, we get the offer price, okay, where the offer price here is equal to a discount. The offer price is equal to 80% of the current market price per share, and the 8% of the current market price per share. The current price is 7.5. Therefore, 7.5. Therefore, for every share to be issued, the company will be paying, okay, $6. Okay. Having done that, if we want to determine how many new shares will be issued, the number of shares to be issued, number of shares, okay, to be issued, okay, will be equal to the number of shares to be issued. It will be equal to the company wants a total of 90 million, okay, 1, 2, 3, 1, 2, 3, and every share they are issuing, they'll be getting $6, as you have seen here. Therefore, the number of shares the company needs to issue, therefore, is equal to 15 million shares. Okay, 15 million shares. Okay. The current number of shares of the company is equal to, if it goes per the balance sheet given there, the company has a total share worth 60 million in nominal value. Okay, and one share has a nominal value of 1. Therefore, the total number of shares this company has is equal to 60 million shares. Okay, therefore, the offer is therefore the new shares 15 million, the old share is 60 million. Therefore, simply a 1 for 4 is a quarter. Okay, therefore, simply a 1 for 4. They have 1 new share for every 4 share you currently have. Okay, 1 new share for every 4. Therefore, the theoretical share price, therefore, will be equal to, you get 1 new share, okay, for every 4. This 1 new share, how much do you pay? You pay 6. Okay. Therefore, how many shares must you have before? You must have 4. Okay. All the value is equal to 7.5, 7.5, 7.5. Then therefore we divide therefore by the old shares, by the total number of shares of this company, which is equal to 1 plus 4 to give us 5. So this is 7.5, not just 0.5, 7.5. Therefore 7.20 can therefore the theoretical exit share price. Is that clear?
So could you please show the offer price again?
The offer price is equal to, you're going to issue, or the offer price is 20% discount to the current market price. You have 80% of 7.5. Clear?
Yes.
Okay, great. Therefore, on how therefore you get the theoretical exit share price. 3 marks. Don't forget, as we had mentioned yesterday, that if the price remains constant, if the share price remain constant at 7.2, the wealth shareholder remain constant. So the benchmark here is 7.2. If the wealth shareholder is above 7.2, an increase. If below, then a decrease. Okay, you get to know the benchmark is theoretical exit share price, $7.2 a year. That's part A. Part B. Discuss whether using the funds raised through the issue share to buy back the bonds is financially acceptable. So first, we need to determine, okay, the company want to use the money, in this case, the 90 million, okay, to pay off the debt, okay, they want to pay off the debt. So you may want to determine how many bonds, okay, in terms of numbers, okay, is the company going to pay off, okay, therefore the number of bonds paid off. Okay, the number of bonds paid off. If the number of bonds paid off, okay, will be equal to. So first, the amount of money you have is 90 million. You have 90 million, okay, therefore 90, 1, 2, 3, 1, 2, 3. What's happening? Should be able to. Okay, 90 million. Okay, there you go. Okay, is 90 million. Okay. Then the amount you pay per bond is how much? How much you pay per bond? The company pays. The company is paying them at their market value. The market value of the bond is 112.5. Okay, 112.5. 0.5, because for the amount the company is paying per bond. Okay. And again, therefore, the number of bonds the company will be buying back is equal to 800,000 bonds. Okay, is that clear? Okay, it is. Therefore, the nominal value of those bonds you have just bought back. Nominal value of bonds bought back. Just nominal value of bonds bought back. The number of bonds. So first, the number of bonds you have bought back is 800. The nominal value per bond you've been told is equal to 100. 100. It means you have bought back bond worth 80,000 in terms of their nominal value. Now, since this is a debt instrument that you have paid off, okay, then how much interest do you save? Okay, we can call them interest saving. Okay, this is a body. This is a debt you have paid back. It means every year how much do you save? You'll be saving. So first, the interest you used to pay on this bond was equal to 8%. And the bonds that the nominal value of those bonds is equal to 80 million. The amount of interest you'll be saving, which you used to pay before, is equal to therefore 6.4 million. So every year you save 6.4 million. Clear? So since this is a saving, it becomes therefore like an earning to the company. This is a saving you have just made. This is therefore an earning to the company. This is a saving, therefore you pay tax. If there's no tax you pay. Do you pay tax? Yes, you pay tax that percent. Therefore, since this is like an income, therefore, that percent goes to the tax authority, you remain with 20%. Therefore, net income or net saving, because net saving per year, therefore, will be equal to 20% of these. I mean, therefore, every year you save 4.48 after tax, that is. Because you pay that percent, it will go tax, you remain with 20%. Therefore, the revised earnings, for this, the revised earnings of the company, the revised earnings of the company, therefore will be equal to the old earnings, okay, before this came over, and the company current earnings, what is it? The company has a total earning of 27 million, okay, the current earnings, okay, as per the profit and loss account given there, 27 million. Okay, 27 million, is it? Yes, okay. Okay, plus the new earnings, which I just made, okay, from the saving you made from the interest used to pay. Therefore, your revised earnings is equal to that 148. Therefore, earnings per share, this is total earnings. Therefore, per share, revised earnings per share, therefore be equal to total earnings, that 1.48, divided by the number of shares. Don't forget you had 60 million old share plus the 15 million new share. 6 million, 3 plus the 15 million new shares, which you have here. Yeah, let's give therefore the revised earnings per share. 60 was the old shares plus the new share, 15, together for combined of 75 million, divided by that one for 80 to give therefore the earnings per share. Is equal to 0.42. Clear?
Still, could you repeat how you got interest saving?
So first you got how you got 6.4 million. You got it?
No.
Sorry?
So could you repeat from number of bonds paid off?
Okay. So first, how much money do you have? How much money do you have? How much money do you have to begin with?
So where?
So how much money do you have, okay, to begin with? Because you want money, isn't it? From the issue of shares.
Yeah.
But how much money, therefore, are you going to be raising from the issue of shares?
90 million?
90 million, yes, 90 million. Okay, the bill is therefore 90 million. And for every bond that you're going to buy, how much do you pay per bond? The last line just before the required, simply after the required.
12.5.
112.5, isn't it?
Yeah.
Therefore, how many bonds have you bought back? 800,000, isn't it?
Yeah.
Therefore, you have bought back bonds in number of 800,000. What's the nominal value per bond? It's 100, isn't it?
Yeah.
Therefore, what's the total nominal value of the bonds you have bought back? It's simply equal to 800,000 times 100, isn't it?
Yeah.
Okay, great. Then, these are bonds you have bought back. In short, you have paid back the holders. Before, you used to pay an interest of how much per year? 8%, isn't it?
Yeah, 8%.
8%, as per the balance sheet given there, 8%, isn't it? Then how much do you save? You'll be saving 8% times what you just bought back, isn't it?
You're paying interest of 8%, so that's a saving.
Yeah, it is a saving. Yes, it's an interest cost. Therefore, it's a saving. Yes, it is a saving. Clear?
No, how is it a saving?
Because you have paid back the loan to the bank. Assume that you used to have a loan to the bank, isn't it? But now you want to ask shareholder, give me money. Then the money you're going to give me, I'm going to pay off the loan which you took from the bank. So is there a saving?
Okay, so it's not a loan anymore.
Yes, it's not a loan anymore. That's the term.
So you save, okay.
It means to be saving. isn't
So
it?
you save the interest. You just pay
Yes,
the
the
principal.
interest, yes.
Yeah. Okay.
It's clear.
Yeah. Thank
Okay.
you.
Okay, great. So since therefore is a saving, is like a sort of an income to you. It's a saving, therefore is an income to you. Okay. And since you pay tax on savings on income, therefore you pay 30%. The government you remain with 20%. Therefore 20% because therefore the net saving, which is equal therefore 4.48 million. Okay. Therefore the revised earnings per share equal to $0.4 per share. Okay. Having done that, we need to get the P ratio. Don't forget we said that you assume the P ratio remain constant before and even after. Therefore, the P ratio, okay, the price to earnings ratio, sorry, the P ratio is here. Yes.
Sorry, can you repeat the revised earnings part?
The reverse earning.
Yeah.
So currently, what's your net profit? As per the P&L there. Sanya, what's your net
The profit after tax,
Yes.
27.
27 million, isn't it?
Yeah.
Plus what you just saved, which is 4.48 million, isn't it?
Okay, just the addition of the two.
Yes, addition of the two.
Okay.
Okay. Then we do that the company uses a P ratio where we assume it remains constant. Okay, always by the way, unless we do that you assume it has changed, you always assume it remains constant before and after. Okay, the market is not going to going to appreciate the company the same way. Okay, therefore the P ratio, okay, which I think we know the formula MPS, the market price per share, the earnings per share. Okay. So first we determine what's the current, before this was done, before the company use of funds, to pay off the debt, what was the company earnings per share? The current, we call it the current earnings per share, not the revised current earnings per share, is equal to, the company currently has earnings worth 27 million. 27 million, 1, 2, 3, 1, 2, 3. You divide by the number of shares currently, 60 million, 1, 2, 3. Oh, no, this is, I've made a mistake somewhere. This 6 million, so let me add a 0. Yes, therefore, the company current earnings is equal to 45 cents, earnings per share. Okay, which is equal to 27 million divided by 60 million. Okay, having done that, therefore, the PE ratio is equal to the market price per share, which is 7.5, the current, okay, divided by the current earnings per share, the 45 cents. And you get therefore a PE ratio of 16.67 times, which we assume it remains constant even after. Clear? Okay, that's clear. Which means therefore, since we assume the P ratio is constant, don't forget P ratio. Let me just get in here. Don't forget P ratio. Okay, is given us. I think MPS, the earnings per share. Therefore, the market price per share will be equal to P ratio times earnings per share. We have the P ratio, which we assume is mainly constant, and we have the revised earnings per share. Here you have it already. And therefore, we can now be able to get the revised MPS or the expected MPS. Let's do that. Therefore, we got the expected MPS, therefore, will be equal to the P ratio, we have it here, times the earnings per share, the revised earnings per share, which you have here, and get $7. So this is the share price we expect, okay, to be there, okay, once all this has been done, at the conclusion of all this matter, okay, be equal to at $7. Clear?
So can you please show the formula again for the expected?
Okay, it will be equal to the P ratio, which is what it here, which was equal to, let me just double click on it, is equal to the P ratio 16.67 times the earnings per share, which is 42 cents. Clear, Nafisa?
Yes, sir.
Okay, great. So if we get therefore the share price will be, therefore will be equal to $7. Okay. We say that the yes, Sanya.
Could you please repeat from revised EPS? I don't understand that.
How do you get the revised EPS?
Yeah, and from further down, like from revised EPS further down.
Okay.
Like I just don't understand the whole bit.
Okay, so first of all, you got how you got these earnings.
Yeah.
Okay, fair enough. Then we need to get to what we call the earning per share of the company. It will be equal to the earnings, okay, total earnings of the company, total earnings. We divide by the total number of shares, total number of shares. It will be equal to total earnings of the company, that's 1.48. We do a total number of shares of the company. The company had 60 million shares as before, plus the new share issued, 15 million. Clear there?
60 plus 15.
These are the old shares, 60 million. These are the new
Oh
shares.
yeah, okay. Yeah.
And this gives therefore 42 cents, isn't it? Which we have here.
Okay.
PE ratio, the old PE ratio, okay, the old in quotes, it doesn't change either way. So it is equal to the MPS. We do the earning per share, isn't it?
Yeah.
MPS was 7.5. That is before the company issued shares, paid the debt, it was 7.5, isn't it?
Yeah.
The earning then was how much? It was 45 cents, which was equal to 27 million, which was equal to 27 million divided by 60 million. This was earnings of the company before, this was the share of the company before, and you get 0.45.
Yeah.
So therefore, we bring it here, 0.45.
Okay.
And you get 16.67. And we say that we assume this remained constant even after. So this remained constant even after. Therefore, you can say, therefore, if we know the PE ratio, we know the earnings per share, then we can get the MPS, isn't it?
Yeah.
Yeah, the MPS is equal to the PE ratio times the earnings per share. PE ratio 16.67. The new earnings per share, we have done it here. There were 2 cents here, times 0.42. Clear?
Okay. Yeah. Can I just copy all this down?
Okay, fair enough. Yes, therefore, and I'll share with you this Excel. I'll share with you for sure. Okay.
Okay, fine. With all this working that you just explained right now.
Oh, the one that I've done in my pen. Okay,
Yeah.
Okay, they'll remain there. Yes, they remain there.
Okay, fine. Okay, that'll be better. Okay, thank you.
Therefore, that's to for the company earnings per share equal to 7. Okay, the company MPS equal to 7. We say that the benchmark. Okay, what is the benchmark? The benchmark was the theoretical exit price where the company, the shareholders' wealth remained constant. Where we have it here. It was 10.2. Okay. Therefore, that in case the share price is going to be above, then that's an indication of increase in wealth. If it's going to be below, that's an indication of decrease in the wealth. Now, 7 is below 7.2. Therefore, what does it indicate? It indicates, therefore, this is not something good for the company. Therefore, what do? We write down here that, hey, this is not a good proposal, therefore. It is going to result to a decrease in the shareholders' wealth. Let me write down then here. We comment, don't forget to comment. Okay, once we have the analysis, you comment. Therefore, the proposal will not be financially acceptable. Financially acceptable, since it results to a decrease in shareholders' wealth. As indicated by the decrease by the actual share price. So in dollars, which is below the theoretical exercise share price, $7.2. Clear? Okay, that's the effect of this proposal on the wealth of shareholder. Okay, therefore this is not a good proposal. Why? What is result to a decrease in the wealth of shareholder? Okay, don't forget, if the share price was 7.2, the wealth of shareholder remained constant. Otherwise, it is not a good proposal. I want to have them in one. Okay, let me just expand here. Yes, okay. Clear? Okay, for 3 marks, these are okay, 3 marks in case you've done the practice, that is. Then part C, we have to discuss the effect of using the cash, okay, on financial risk of the company, as measured by interest coverage ratio and the debt to equity ratio on book value basis. Okay, so the gearing, the effect it have on the gearing. Okay, the gearing here is debt divided by equity. So currently, we need to get the current, okay, at the current position of the company. Currently, okay, the company gearing is how much? The debt of the company currently is 125 million. So 125 million, so is equal to, so equals to 125 million divided by equity. The company equity here is equal to 80 million. 80, sorry, it's one. What's happening? Okay, this is a mix up here. Okay, so the equity is 60 plus 80, which is 140. So therefore we divide by 140. Okay, and of course we express this as a percent. Okay, the company therefore has a current gearing of 89.3%. So if this is going to decrease, that's a good sign. But if it's going to increase, that's a bad sign. And let's do the proposal. And the proposal, the company debt has now decreased, okay, from 125 million. It has decreased by 80. Don't forget, okay, I think we did that already. The decrease was 80 because you bought share worth with a book value, nominal value of 80. Therefore, the 45 million is a balance. Okay. The company equity has increased from 140. You have issued shares worth 90 million. Is that clear? You bought bonds with a book value of 80, not the market value, book value of 80. They will remove 80 from the debt. Then you have issued shares worth 90. If you add 90 to the company equities, it's because this is right issue share, which is equity. Clear? Okay, it's clear. We therefore give therefore a ratio of how much? What percent? 19.57 or simply 19.6%. Is a good proposal? Is it going to decrease company financial risk? Yes. Why? Because the company gearing ratio is decreasing from 89 to 19.5%. Do you have benchmarks? Do you have the industry? No. So you can still make, yeah, we can still make that a comment. Okay, the proposal. Under the company, under the proposal, the company financial risk, will decrease, will decrease, yes, decrease, as shown by the decrease as indicated by the decrease in the gearing ratio from 89% to 19.6%. Clear? That's for the company gearing, as you make the comment. Okay, this is a good proposal. It requires a result of decrease in the company financial risk, as shown by the decrease in the gearing ratio from 89% to 19.6%. Okay, what about on the interest coverage ratio? That's the next thing, the interest coverage ratio. How many times the company profit can pay off the interest? Okay, coverage ratio. Just as we said, is given us. Okay, equal to the profit earning before interest and tax. Interest and tax. Okay, we divide by the interest. If the ratio is quite high, that's a good indication because you can pay more time the interest from your earnings. You have more earnings in short, okay, to pay off the interest. If the ratio is decreasing, then that's a bad indicator. They have current position, so currently the company interest cover ratio is equal to earnings of the company. Earnings of the company is how much? The company earning before interest and tax is 49, so equals to 49 divided by the interest of the company, which is equal to 10, therefore 4.9 times. So if you believe the proposal, it'll be how much? The company profit before interest and tax still remain at 49, okay, divided by the company has, we used to pay, okay, interest of 10 million, but now they save 6.4 per year. Just to refer back to what we have just done, you'll be saving, here it is, the company save, okay, let me just highlight 6.4, okay. The company save, therefore, don't forget here, this is the company saving. You'll be saving interest of 6.4 million. You used to pay 10 million. Then after, how much you'll be paying? 6.4 million. You'll be saving 6.4 million. Therefore, your new interest is 10 minus 6.4. Clear? Okay, I guess it's clear. Therefore, we minus 6.4. 6.4. Okay, therefore, our new interest coverage ratio. Is it good or bad? This is good. It is increasing. Okay, it is improving because you can pay more times. Okay, the company financial risk. The company financial risk is decreasing. As indicated by the increase, as indicated by the increase in the interest coverage ratio. Okay, from 4.9 times to 13.61 times. This is a good proposal, therefore, in terms of, okay, financial risk management. But don't forget, it's not a good proposal to the shareholder. Why? Because the shareholder's wealth is decreasing. Okay, if you still remember. But anyway, there's still for part C, that's a comment. For part B, that's a comment. Not a good proposal for part B. For part C, good proposal. Clear?
Sir,
Mm.
It's not a good proposal for B because it's the price is decreasing from 7.2 to 7, right?
Yes, the shareholder's wealth will be affected. Why? Because the share price is decreasing. Because the current share price of 7 is below the 7.2. Okay, where the shareholder's wealth was meant to remain constant.
Okay.
Any question? So okay, this is a question that you examine asked. Okay, no, not asked. And there's another question that your examiner had asked. Okay, some few years later. Okay, so I will do that. So I'll ask you to, on your own. Okay, you go and make that attempt. Let me try to track the question for you. An exact same question. There's no difference at all, by the way. An exact same question. So let me go back. So the next topic we shall be discussing will be on cost of capital. So the next thing we shall be discussing together will be on cost of capital. So for your own sake, try to do this question. The same thing we have done, okay? There was no any difference, but the examiner asked you some few years later. So where could it be? Okay, the same thing you can do also here in this is page 44, 45, okay? You can do A for now, but you can do B, you can do C, you can do D, okay? This is page 44, a company called GXG, okay? GXG company, but that's not what I was looking for. I was looking for a question that is exactly like what we just done. There's no distinction. The same step, if you follow them, you arrive at the answer. This page where is this? Yeah, it is. This is called a company called Green Up Company. A company called Green Up Company. Okay, in page 65. Green Up Company, page 65. Okay, the first part you meant to evaluate the effect of the proposal to use the funds to pay off the debt. Okay, on shareholders' wealth. The same step, no distinction at all. Okay, Green Up Company in page 65. Clear? Question? Okay, no question. Great. Then let's meet next week on Monday. We do cost of capital. We see how far it can go.